Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
How to beat inflation resoundingly as an investor. Inflation around the world has started to soar again. As a young man of the 70s, I remember only too well how devastating inflation was. It averaged in the teens for the entire decade. Can you believe it? There are a number of lessons to be learned from the 70s as an investor, the main one of which was to invest in so-called real assets. In other words, assets that are capable of maintaining and beating inflation. There are four main investing asset classes, which are cash, as represented by bank and building society accounts, bonds, by which I mean corporate bonds and government stocks, property, which means commercial property, in other words, offices, retail and industrial, and equities, otherwise known as shares. The only two real assets are equities and property. In times of rising inflation, all things being equal, you should seriously consider investing the largest proportion of your investable assets into these two areas. This does, of course, presuppose you're investing long-term, 10 years or more, and you have the right attitude to investment risk. With UK inflation, as measured by CPI at 6.2% per annum at the time of writing, and interest rates from bank and building society accounts typically less than 1% per annum, it means you are losing approximately 5% a year in real terms, in other words, inflation adjusted. As for bonds, well, I consider them a lost cause at this stage of the economic cycle. As interest rates rise, and they could well rise a lot over the next 2 to 3 years, the value of bonds will likely plummet. In my opinion, it is inevitable. Bonds produce income in the form of interest and have the potential for capital gain, unlikely at present, or capital loss, more likely at the moment. The income yield from bonds is very low currently, like cash, so you're losing money in real terms by about 5% a year typically, and you are highly likely to experience an actual capital loss in value, let alone the impact of inflation. Whilst these are the four main assets recommended by financial planners, there are others worth a mention. For example, commodities are worthy of a mention. The demand for commodities is likely to rise substantially over the next few years, and the price is likely to rise too. As for precious metals such as gold, the price of these should rise significantly over the next few years as well. Read my blog on gold, which is titled Why You Should Invest in Gold Right Now as Its Future Glisters. That's to be found on our website. So there you have it. How can you benefit from investing in real assets and avoid investing in bonds and cash? Well, by investing in the discretionary fund management service run by our sister company, Minerva Money Management. If you're interested in finding out more about this service, do get in touch. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.